What's cooking, Gumbo Nation? You're listening to Mortgage Gumbo with Dwayne Stein right here on iHeartRadio, and I'm your host, Dwayne Stein, the Gulf South Mortgage Authority. This is your home show where for 11 plus years we've been providing education and options on what is or will be your largest investment and most valuable asset. What is that? That's right, it's your home. And if you're new to the show, welcome to the Gumbo Nation. We're glad to have you with us. Excited. If you want to join the show, 504-207-7600, or shoot an email to info@mortgagegumbo.com. The home away from the show is mortgagegumbo.com. Appreciate all those who hit me with a .com when you see me, so love it. All right, on the show today, got a lot to get to. We always do. But we're going to be discussing what is home appreciation. Want to give you the big picture because got some decent numbers out this week. But want to explain sort of what appreciation is. And understanding. We talk about all the time on this show that owning a home is a wealth-building tool. So we're going to talk about that. We're also going to talk about, because I see this all the time, and this is top credit mistakes that consumers are making, not home buyers, homeowners, consumers. So we're going to get into that. Because some of you I want to help, maybe those moms and dads of folks who, you know, young kids going to college. Talk about how this week, share a story of one of the 10 commandments came to light. And tell you the difference that has. So we're going to talk about top credit mistakes that consumer makes. And then we got tons of questions. If we could get to them, we naturally will. But let's start with pending home sales for the month of July. And how do I say sucks? Disappointing? Down 2.3% in July. This is the lowest level since January. And why is that? Well, we've seen mortgage rates spike back up. Oh, Dwayne, don't mention that rates have gone up. Why? That's why you listen. This is why you trust me. This is why we're still closing loans. Because right now, we have to be perfect. And we've got to turn over every single stone. And we talked a couple weeks ago, back in May, we said, look, when this stuff started kind of going south with this ceasefire and all that, we said, look, things are probably, this summer buying season is not when you want spring into summer. This is when folks are buying. This is not when you want to have, during peak buying season, elevating rates. And we saw that. And we saw that in all four regions. They break it down, you know, north, south, east, and west. We're in the south, by the way. So, you know, when you're looking at this and you look at these pending home sales and the drop, you look at year-over-year purchase applications are down 3%. Refinance applications are down 18%. So is it stale? Is it, what's that smell? Is it, the date on the milk says August 26th, but when I put my nose in it, is it in my head that it smells a little off, or is it? So that's why we rely on data. And these things lined up to the point where in July you had these down. Now, folks are buying, at least with me. But what you need to make sure, if you're listening to this and you're not sure, my gosh, I don't know what to do, you just got to get with somebody that you trust, that you could have a true conversation with. And when you compare year over year, you go, oh, wow, okay, down 2.3%. Well, Gumbo Nation, when you sit here, and I went back and looked and said, all right, well, let's see where we were last year at this time, because we do our credible segment, Rate Watch. So last year, a 30-year, we were starting to celebrate. And last year, a 30-year conventional loan was 6.52. And this week, that same 30-year conventional is at 6.77. So I don't know about you, but carry to 3, add to 4. You know, you're looking at 0.25%. But I've been telling you, rates are fighting for us. And when you look at last year, the 10-year Treasury was at 4.327. This week it's at 4.732. So that's 40 basis points. So most of you know I always use the margin, right? Like kind of as 1.75. And that gives you where the rate should be. So if you take last year's 4.327 and you add 1.75, we were at 6.077. And the rate was 6.52. So we were off 50 basis points. This year, I'll 4.732. You add 1.75. The rate should be at 6.482. So we're off 30 basis points. Or a quarter. A little bit more. So if you add that to where we're at today, and this is why when people go, oh, the Fed, we're fighting. And the Fed doesn't control mortgage rates. Inflation does. And it is fighting the rates. I've been telling y'all, it's fighting. And this is proof. I want to bang on the desk. Because if we were sitting here with the same margins as last year applied to this year's rates, we'd be having a whole different conversation. I'd be coming in here saying today's the rates are 7.07. And I'd be handing out ropes, showing people how to make a noose. Become a how-to show. So we've got to keep things in perspective. And my point of that is saying that even though we're looking at year over year, it was a timing thing. And look, this war is affecting home buying. And we've always talked about, world strife is better for interest rates because people fall back to treasuries and they fall back to the security of bonds. Well, why isn't that happening right now? Because we're dealing with the Middle East, and even though none of our oil or whatever comes out of, all that stuff, it's affecting us. because oil prices overall, when I say oil, think gas, shipping, fuels, goods. That affects everything. Whatever you make from oil. So the inflation is what is keeping bond yields up right now, like the 10-year Treasury, and that's what drives mortgage rates up. So that is where this effect, and when you want the why, without me getting into a bunch of jargon, that is where we're at. It's a domino effect. So when we start looking at this, because what does that do? The higher rate does what? What do we talk about? Affordability. How much can I afford? What is my monthly bill going to be? Well, I'm going to wait. I'm going to this. I'm going to that. So I get it. But I'll continue to say, again, our rates continue. They continue to fight. And is there some golden goose? I mean, look, Besson on Wednesday comes out and says, hey, the Treasury is going to go from buying $2 billion to $4 billion in bonds. They're trying to create liquidity. The Treasury's trying to figure out what they can do because the market is a little bit stale. People are scared. But folks that are doing their research and the conversations that we're having, they're also seeing that they've been able to take advantage of some things right now. Like getting the seller to pay closing costs. Figuring out, and that's what we're going to talk about today, and that's why I wanted to bring up appreciation so folks can understand the long game. So we've got a lot of that and more that we're going to get to as the show rolls on. So we're going to talk about what is appreciation, top credit mistakes that consumers are making. Hey, next week, I'm contractually obligated to say, hey, next week's going to be our annual fantasy football spectacular with the Sherpa, Jason Fontenelle. He's going to be in studio, so look forward to that. Set your calendar. You know, we take a little bit of a break from the real estate to show that we are human, and we'll get into that. So, all right, don't go anywhere. If you do, we'll find you. It's football season. The Hoodats play today. There's a lot to be excited about. And again, like I said, we'll be part of that next week fantasy football spectacular. But on the other side of the break, we're going to be talking about top credit mistakes consumers make. And what is appreciation? We're going to give you the big picture. You're listening to Mortgage Gumbo with Dwayne Stein right here on iHeartRadio, 504-207-7600, mortgagegumbo.com. Man, think about this song, folks. Y'all probably remember the big boom boxes. I mean, this is what was playing. You put that cassette tape in with the big speakers, threw it up on the shoulder. This is one of those songs that takes me back to those good old days. All right, welcome back. You're listening to Mortgage Gumbo with Dwayne Stein right here on iHeartRadio. Hey, home away from the show. Look, just Google Mortgage Gumbo. You can find us, YouTube, over 1,000 videos up there that you can go look at, all about your education. Want to just always say thank you to you, the Gumbo Nation. Because of you, we're the top 1% in the nation, loan officers. So thank you for the trust. Truly appreciate that. As stated earlier, hey, next week we'll be taking a little bit of break from this. So, hey, but, tune in. Wildly popular, the fantasy football Sherpa Jason Fontenelle will be joining us, so we'll be able to help you make some money in a different way. All right, so want to kind of get into just common credit mistakes. And this isn't for homeowners. This is just in general. I see this every day. I look at credit bureaus every single day. I've been dealing with credit for 30-plus years. And, look, some of these things we're going to discuss is worth mentioning, but we may not focus on as much as some of the others. So, one of the biggest common mistakes is making late payments. Duh. Right? Duh. But what you've got to understand is this is the biggest factor when it comes to your credit score. It's 35% of your credit score. Another common mistake here is maxing out credit cards. Keep in mind, the second largest part of your credit score is utilization. When it comes to revolving debt, how much of that balance or credit limit do you utilize? And moms and dads, this is for you, especially those trying to help establish credit. And because, look, a lot of our kids, I've got a 20-year-old, they don't even know what money truly is, right? We're trying to teach them the value of money. Think about how many of them they've seen pictures of dollars, they've seen pictures of things, and maybe they get something in an envelope when they were a kid, right? But change, what is that? So, what do they see? Venmo, Cash App, right? They're not going, hey, spot me 20. You got a $20 bill, spot me. No, it's a debit card. And what I want folks to understand is, when you're helping them establish credit, maybe you're getting them that first credit card. Or if they're in college, be very careful because they're on the campuses, and I learned this the hard way, is make sure that their limits are limited. Maybe $300, $500. Something that, if they're not listening right now, that you can bail them out on. That's why I always recommend when you're getting them started, put them as an authorized user on your established credit cards. And the reason why I bring this up is, this happened to me firsthand in college. Walking through the student union, hey, apply for a credit card. Great, okay. They gave me $1,000 on my credit card. You're talking about $1,000 to a kid who, and I swear I'm going to write a book, how to get through college without a car. And I didn't do college in 1 or 2 years. I did Cinco. I went 5. And that's not as much as some of my friends, Jason. But So a kid going through college, no car, got $20 a week, all of a sudden gets $1,000. I didn't know the value of money. Are you kidding me? Thank goodness they didn't have Starbucks, Chick-fil-A, all the restaurants. But they did have beer back then. Maybe I used to buy extra, let's go with ices. So my point being here is if you're helping them establish credit early, let's try to be smart with that. Either doing it through an authorization, or if you're going to help them apply for that card, talk to them about it, have that conversation, but let's set that limit low. Or if they get approved for $1,500, get the credit card to, hey, only allow $500. They could set the limit. So that's important. Because you can't put toothpaste back in the tube. A huge mistake, and I don't know where this comes from, and it's just bad advice. And maybe it comes from, hey, maybe moms, dads, aunts, uncles, grandmas, grandpas. Maybe because you've done it and it maybe hasn't affected you because you got 40 years of established credit. But you don't want to close out old credit cards. You know, if they've got an annual fee or something like that that you don't call, negotiate it. But that reduces this. This has a direct impact on your score. And you could have been paying it great for 5 years. But it reduces your available credit, which is your utilization, which is 30%. But it also reduces your credit history, which is 15%. Oh, and you lose all that great pay, which is 35%. So by you closing out a credit card, it's not just, hey, I save $49 on an annual fee. You just lost 80% of your credit score by doing that, or 80% of what's impacted by closing out a credit card. Another common mistake, or common mistake number 4 here, ignoring small balances. Look, they've gotten a lot more lenient on these things when it comes to, you know, hey, medical bills. All right, we don't have to count that against you. Or depending on the loan type, hey, if you've got derogatories, we don't have to count that, or it's only a certain percentage. But you know what it doesn't get lenient on? Your credit score. Right? So at the end of the day, ignoring those small we don't have to pay we don't have to pay off medical bills anymore. But now it went to collections and it affects your credit score. It gets thrown over to collections. They report that. That affects your credit score. So don't ignore it. It's not, and I get it, it's not going to go away. Look, I get them in the mail all the time, these bills. You still now owe this. And it's a nightmare. And I'm like, but I paid my deductible. I have insurance. Why is this? Why is that? And you ignore it. And then you get the second one. You still owe this. I'm speaking from honesty. And then I'm like, I got to take 5 minutes and make a call. And a lot of times they're like, oh, no, it's not a bill. Or, okay. But you can't ignore those things because you don't want something going to collections and trying to prove later on that it shouldn't have. Because you can get somebody to tell you all day long, oh, that shouldn't have happened. Great. Are they willing to remove it from the credit bureau? No. Companies aren't going to do that. This one should throw off alarms. Like sirens, air horns, air sirens going off. Ding, ding, ding. Ring bells. Whatever it needs to be for number 5 here. And that's co-signing for someone else. This is one of the 10 commandments. In this week, this is what led me to this topic. This week, have a buyer, married couple, who now, instead of being able to buy $525,000 in affordability, buying power, is now down to $300,000. Because father co-signed for daughter on a mortgage. So as we always talk about, it's a good thing you're trying to do. It's a good deed. But that becomes your debt. And they didn't think they'd want to move down the road. And I get it. But what do we talk about on the show all the time? Life happens. So now, and not only that, well, Dwayne, why did it go down $225,000? Well, not only that, the daughter in the last year has missed a payment. So now we've got to remove dad from the application, which means now we only have a certain program we can go with. And we lose all of dad's income. So co-signing is never, ever a good thing. Ever. And a few quick ones here. Buy now, pay later. Satan, devil, in disguise. Not monitoring your credit. In today's world, listen, all these free credit scores you get, don't look at the score. These things were all set up years and years and years ago for monitoring purposes. That's what you need to make sure, because the score, I could promise you, it's irrelevant. That score is for reporting purposes, not lending purposes. And then one last one is, don't go out. If you're thinking about making a big purchase like buying a home, don't go out and buy toys. Somebody else this week. I know it's hunting season. Got my buddy Dean, super buck hunter. So he knows. But guy went out, wanted a new 4-wheeler to head out to camp for his camp this week. So he bought a new 4-wheeler, then applies for a mortgage. The financing, it's $300-something payment. Okay, you could afford a house, but it would have been $100,000 more. So those are just some common mistakes. So if you wrote those down, if not, hey, go to YouTube. You'll be able to find this stuff here, but just wanted to make sure we're sharing that with you so you could always have yourself in an optimal spot, whether it's buying a house or doing anything, to make sure credit is up there with air and water, Gumbo Nation. All right, don't go anywhere. On the other side of the break, we're going to start talking about appreciation. What is it? And how your home helps you build wealth. You're listening to Mortgage Gumbo with Dwayne Stein right here on iHeartRadio. Mortgage Gumbo. .com. Welcome back. You're listening to Mortgage Gumbo with Dwayne Steiner right here on iHeartRadio. Home away from the show, mortgagegumbo.com. John from River Ridge. I apologize for this lengthy question. My son is getting married this fall. This past week, we were discussing him buying a house and affordability. We said you need to talk to the Mortgage Gumbo guy, so he'll be calling you. Appreciate that, man. But when we were talking, he said that he knows that his fiance has had some past credit issues from college. How can we, without being helicopter parents, find out if this will hurt home buying options and confirm her debt isn't his debt? Can you confirm that? Yes, her debt prior to marriage is not his debt. However, while this is a lot to unravel, once they are married, her debt will affect future purchases for your son. And I look forward to working with him and helping him, but let's sort of, because a lot of you may have these questions, right? And so how do you find out? And, you know, I think this is where, hey, if you're marrying somebody, you've got to be able to have this conversation. And, you know, I'm no therapist, but I'm much better at loans than love. But what we need to do is, you know, we need to just say, hey, let's get our finances in order. Because we both want to buy a house, let's kind of start getting everything in order so we could see exactly what we can do. Or, hey, my dad's got a guy. Why don't we give him a call so we can learn what our buying power is now? So if there's anything we've got to work on, we'll know. And in this way, hey, use me. But we could find out. But again, her debt, her credit score, her whatever she's got, student loan, none of that becomes your son's or the spouse's. But once you get married, that debt, or her, if she's a 580 credit score and you're 800 and you're applying for joint credit, that could have an effect. Or, like in the previous segment when we talked about the co-signing, it could limit what programs you're able to go with. And then if we've got to remove her from the application in this situation, then that will affect buying power, especially if we're planning on using her income. But I recommend that conversation to be had all the time. All the time. And I see this. Well, my credit score is 750. Or I work, but my credit score is a 600. My wife doesn't work, and hers is a 800. We got to use where the income's at. And when you're looking at joint credit, just so you know, we use the lower middle score. So that's a great question, and I know that's one I wanted to read there, and you know, and obviously he's listening right now because that came over. So these are conversations that we want to make sure that we're having. Because in reality, it's almost like co-signing, right? Once that happens, if you don't have it straight, you now are limiting yourself on what you can do down the road. Yeah, you can go buy a car because it's your car. But when you go buy a house, and if you're planning on using his or her income or significant other, then that's something that you're looking at there. That's got to be discussed, especially when you're starting out. Look, when folks that have been married 10, 15 years, they know. They know what issues have happened. They know why such and such's credit might have gone down. They know those things because they've been in the trenches together. They've made maybe good or bad decisions together. Or they've accepted his or her bad decision and said, I'll just live with it. But prior to marriage, strongly recommend. And I just say, hey, let's get our finances in order so we could see exactly where we are. Because it's just like the same person that goes, oh, okay, hey, I pay cash for everything, so I don't need credit. Or I got a great job out of college. I'm not worried about credit. Listen, credit's right up there with air and water. And we see this a lot, especially young home buyers who are starting out and want to buy and not at their peak earning years yet, but still doing well. We want to be able to count both folks. We want to be able to count both of you, especially in a market like today where it's elevated rates and affordability strained. We want to be able to go, all right, hey, let's look at this. Let's figure it out. How do we win here? So that's a great question. All right, let's do this, JP. Let's break because I don't want to start this segment here. I'd rather have a full segment to get into what is appreciation and talking about how your home, it loves working for you. You're going to work hard for it, but your home is going to pay you back. Don't go anywhere. Hit record. You're listening to Mortgage Gumbo with Dwayne Stein right here on iHeartRadio. On the other side of the break, we're going to explain what appreciation is and just a 3% return, what that can do for you. Don't go anywhere. Mortgage Gumbo with Dwayne Stein. MortgageGumbo.com. Welcome back. You're listening to Mortgage Gumbo with Dwayne Stein right here on iHeartRadio. We got one segment left. Hey, tune in next week for our 11th annual Fantasy Football Spectacular. The Sherper, Jason Fontenelle, will be in studio. We'll be taking a little bit of a break from business just to show that we are human and helping you make money in other ways with a little fantasy football. All right, let's get into our weekly segment we like to call Raid Watch. All right, folks. Conventional loans last week, 671. This week, 677. Aye, that's ugly. If you heard us talk about earlier, rates are fighting for you. Rates are fighting for you. If the 10-year Treasury, if our margins, if the investors were not fighting for you right now, you'd be looking at rates in the upper sevens. Or the lower sevens, sorry. When you're comparing this year to last year. 15-year, 6.61. FHA, 6.33. Jumbo, 6.8. VA, 6.35. Rate's a number on a piece of paper. You need to work with somebody that is going to cultivate your need, your home buying need, and show you what program we've got down payment assistance for all these programs to meet your needs. So let's have a conversation. Go to mortgagegumbo.com. And yes, everybody's always like, oh, man, you sound just like radio. Yep, I got a face for radio. That's why I do radio. But, yeah, you're going to speak to me personally. Yes, stay on the phone all day long. But I love it, and I love you, Gumbo Nation. Keep sending it out. Your homework will always be just go tell one person this week about mortgagegumbo.com. All right, so let's talk about what is appreciation. Report came out this week that, hey, appreciation year over year is going to be looking at 3%. Oh, 3%. Well, I mean, I could make this in the stock market. I could do this in crypto and Bitcoin. And would we want it to be higher? Yeah. Yeah. But buying a home is the long game. So I want to talk to about appreciation, and I'm even going to get on like returns on investment because we don't hide anything here. We want you to have not the big picture, the full picture. So we want to use a crystal ball, so to speak. But when you're looking at appreciation, and sometimes that gets confused with equity. So appreciation is your home becoming more valuable because you've owned it while the market value has increased. Equity is what you own after subtracting what you owe. So appreciation is the wealth building. Equity is the cash, so to speak. And I think it's important because, we've got folks who are coming off of when we had appreciation in 20 and 21 of 18, 19%. Folks, that's not normal. That's not normal. Normal home appreciation's always been between 3 and 5%. And what I think folks need to understand is, all right, well, why do homes appreciate? And it's a combination of things. Supply, demand, population growth in certain areas. You start putting some data center or you start putting Amazon comes into a certain area, guess what's going to happen to homes in that area? It's going to blow up. Why? Employment. Out west, Louisiana, all this LNG companies coming in. Home prices, homes appreciating, demand. So if you've got 100 buyers, right, and I'm trying to make it visual for radio. If you got 100 buyers but only 75 homes are available. Well, you got buyers competing for those homes, so that pushes prices up, right? That's a seller's market. But if you got 100 homes for sale, but only 50 buyers, well, now price pressure is coming down. It's reduced. So that's a buyer's market. Think about the Saints, right? Hey, if it's sold out and you got 10,000 people want 500 tickets for a game, well, those tickets just became more valuable. So they appreciate, right? It's worth more. So, the factors when you're looking at this and you need to understand is there's tons of factors that go into it. Schools, areas, right? Where do you want to be? But I think what it's important to understand as well is home appreciation, when buying a home, it is a wealth-building tool. We preach this every single week. That's the point of the show, of understanding it's a wealth-building tool. It's not a get-rich-quick scheme. Oh, I'm going to buy a home and plan on living in it 2 years and then sell it and then buy another one 2 years, then sell it. That's probably not a good move. Now, life happens, but that's not a smart move. That's not how you build wealth. And that's why it's important to understand, and I mention this time and time again, is that it is the long game. Because appreciation doesn't happen evenly every year. There's no guarantees, right? Might go up 2%, then you go 4%, then you go 3%. And there's a lot of people that owned homes when 2021 happened, went up tremendously. A lot of people bought at the peak of that market. And maybe they're not happy with the folks that sold are happy, but those who bought are going, wow, I've got this 3.5% rate, but my home value hasn't gone way up. So here we are 5 years later, and you know what's happening. And again, this all kind of goes into, so what happens? Those folks become landlords, right? Because they hold on to that lower note.
2 minutes.
But they've got to buy something else. So what you've got to look at here when it comes to appreciation is, what is your return on investment? And if you're looking at the long game on a $250,000 house that you put down 5%, so that's $12,500. Let's throw in another $5,000 in closing costs that you got to come out of pocket with because the seller didn't pay it. Well, in 3 years, you made 113% return on investment. See, I'm counting. I am counting the money that you're using. In 5 years, you've made 250%. 10 years, 616%. The average homeowner stays in their house 10 to 12 years.
1 minute.
So we've got to make sure that we are looking at, Gumbo Nation, when it comes to and thinking about home ownership, it's appreciation. That increase in home value. What is that return on investment? And knowing that your equity is going to grow, not just with appreciation, but then you start getting into things like biweekly payments where you're paying that mortgage down. And then you're growing that wealth. Let's have a conversation about this. Let's have conversations about what your goals are so I can find a need and meet your needs when it comes to home buying.
10 seconds.
Anything mortgage related, it's very simple. Go to mortgagegumbo.com. Till next week, Gumbo Nation, keep stirring the pot.